And you can see oil up over 5.5%, but well below $100 a barrel. Right now trading at just about $96 a barrel. And I think that's where we have to start, Joe. The impact that the rise of oil prices have had on the broader economy. I have to include in there also diesel prices here in the U.S. We're going to talk more about that. Really the fuel for transportation here in the U.S., raising the cost of shipping. But in general, consumer confidence falling on these rising oil and gas prices. What do you do today on this Monday with so many questions about Iran and the path forward?
That's a great question. Look, I think markets have a rhythm for their movement, and I think 2026 you could define the rhythm of the market as a roller coaster. It feels as though each day it's exactly that. You get on the roller coaster and you basically get off in the same spot. The operator of the roller coaster right now appears to be the price of crude oil, and wherever the crude oil market is going to go takes where the overall market is. There's resiliency in the market for sure. I continue to say if you have a hyper volatile environment where it is resembling a roller coaster, just this ride basically back to where you began, in that scenario, what do you want to do when everything looks really, really good? You probably take the other side of that. When everything looks really bad, you take the other side of that as well. But as it relates to crude oil, at the end of February, the average volume for spot crude oil was 300 contracts per day. We're now running close to 1 million contracts per day being traded in spot crude oil. So, look, that tells me I understand the fundamental concerns that speculators might have, but that's beginning to feel a little bit like silver 1 month ago, where we're beginning to see some of the excessive speculation take hold within the marketplace. Take comfort in two things. Last point. Number one, we are seeing that the Mag 7, in particular, the NVIDIA, the Alphabet, the Apple, they're doing what they're supposed to do. They're being perceived as quality, a port in the storm. And then I think you have to look at the fixed income market and see the incredibly calm environment. So far, year to date for a 10-year Treasury, you're talking about only 38 basis points with a range. Fixed income trading really well.
You know, you mentioned the word resilient, or resilience, I should say. Some people are also saying complacency. I'm looking at the S&P about 4% away from its all-time high. The NASDAQ 100 about, 6% away from its all-time high. Steve Weiss. Are investors, and Joe just mentioned the bond market, are they complacent or are they resilient in this situation? The fact that we might even see the NASDAQ turn green during this show?
Well, it's an interesting question. By the way, I think I'm tired of the word resilience. Everybody uses it for everything. Investors resilient, retail's resilient.
What's a better word?
Resilient. There is no word for it because it really doesn't come into play. Markets go up 90% of the time. Anytime you sold during geopolitical risk, or anytime you sold, period, right, over the last few years and stayed out, the market's higher. Right. So in terms of complacency, that makes you're essentially making the judgment that there are real issues there that the investor is ignoring. And the truth of the matter is we don't know. So if you go back to how everybody was looking at this year, not just me, but you and everybody, volatility, right? Now, nobody expected this kind of volatility. This is volatility on steroids. And you can look at volatility, you look at it one of three ways. Okay, retail investors tend to look at it as risk, right? Others, I think, hedge fund managers, professional managers look at it as opportunity, right? Displacement, either to get out of shares. Volatility cuts both ways. Goes up, right? There's volatility higher, volatility lower. And then you can look at it as a nuisance. I think in this market, it's a nuisance for now. However, if you ask me what I'm concerned about, and I mentioned this on Friday, I am concerned about stagflation. We're seeing jobs growth negative. We're seeing inflation hold before this higher than what the Fed was looking at. So when you have inflation moving higher and the economy moving lower, right, that's stagflation. Now the question is, how long will that last, and are we actually in it? We don't know. Everything at this point depends on the duration of the war. Trump could come out any day, any moment and say, hey, victory, right? And we'd all go home, market would go up. And you still won't see the impact of the problems until later on. So the point of all this, my conclusion is that you hold where you are now. Anytime, as I mentioned again last week, you tried to catch a falling knife, you made a mistake. You got cut hands instead of buying values. So I think you can wait, right, to put money to work. Having said that, depending upon your time frame, depending upon what you're buying, right, You can hold it, except for things that I still think were very overvalued going into this. They're still overvalued.
Are you lumping software in that group? Are you
software? I bought Microsoft.
Discount retailers in that group, because a lot of things are falling that I don't think people thought were overvalued until this happened. The rise of oil prices changes the math.
That's not true in software. That's not true in software.
No, I'm asking, are you counting software, but discount retailers?
I didn't hear anybody. But not because of
nobody said those were overvalued until this happened, and now all of a sudden we're seeing calls for those to sell lower.
That's not true. Plenty of people said software's overvalued.
No, I said discount retailers. I'm saying there's different parts of the market.
Yeah. Discount retailers, you just don't know. You don't know how this is going to perform.
Okay.
Look, most of two-thirds of the country lives paycheck to paycheck. So now with fuel prices going up, how they've gone, I mean, saving grace, we've got warm weather across the country, right? So less heating costs for this time of year. But now they've got to put gas in their tank. They've got to put energy into their home. Right. So discount retailers, they're going to have a tough time.
All right. You don't like resilient. What about constructive? Jim, I'm going to come over to you. Mike Wilson from Morgan Stanley out with a note saying in part, I'm just kind of summarizing part of it, we think we're closer to the end of this rolling correction than the beginning, talking about the falling knife that Weiss was just mentioning. And Morgan Stanley remains constructive over the next 6 to 12 months, speaking of a time frame. Agree or disagree with that take?
I can't agree or disagree on it because it requires some prediction of when the war is going to end, and that's not knowable. That's not something that you can do a degree of analysis and come up with when the Straits of Hormuz are going to open to tanker traffic again. However, that is the key point. That is the pivot point upon which the markets hang right now. When you start to see tankers other than Iranian flagged or Iranian associated tankers transiting the Straits of Hormuz, that's when you'll see oil come down and you'll see the markets rally with it. The weakness in the market, and as much as I'm happy to see that there's been an intraday rally, I'm not sure I trust it because the markets just don't know how long this oil spike is going to last, and it will do damage. The good news here, Frank, is before it does damage, there are cushions both in the economy and the financial markets, whether it's growth in GDP, whether it's the fact that inflation had been coming down, profit growth, stimulus from the budget bill, a number of cushions, but we see those cushions being eaten into, for instance, with Friday's labor reports. The point of this being is that the longer this goes on, the more damage will be done, and frankly, there isn't that much time left until we get the Straits of Hormuz opened if we want to avoid damage. The president says this is a 3 to 4 week operation. Okay, if that's the case, maybe we'll skate through without lasting damage, but frankly, I think the markets want to see tankers transiting the Straits of Hormuz this week. I'm going to keep my disciplined, diversified portfolio. I'm not panic selling here at all, but I am keenly awaiting news of tankers transiting the Straits.
But it's not just when the Straits open. It's if there's more damage done to the oil production facilities in Saudi Arabia, throughout the Middle East. That's part of the issue.
I want to refer to something our Brian Sullivan has said because he's coming up in just a second. He said it's not just about getting the oil out. It's if other ships feel safe enough to go back in and just keep the supply chain going. So speaking of Brian, for much more on the turnaround in oil, I want to bring in our Brian Sullivan. Brian, we're looking at oil move lower. We're also looking at the NASDAQ right now, Brian, very close to at least flat, possibly turning green, looking at oil WTI at least, trading about 96.60 a barrel. What's the very latest?
Well, we got some breaking news on CNBC.com, which I think goes exactly to your conversation about the Strait of Hormuz. And if I'm right, this could bring oil down even more. I'd love to get the former oil trader Joe Terranova's view on this. But the Iranian Foreign Ministry is saying, and I'm not sure where they're saying this, it's up on CNBC.com right now, that any tanker transiting the Strait of Hormuz, quote, must be very careful. Now, interesting language, because if you read into that, and again, love Joe, the former trader's take on this, if you read that, must be very careful is not we're going to blow you out of the water. It's you cannot pass the Strait of Hormuz. It is not we're going to send missiles your way. Must be very careful. To me, and I'd love to hear everybody's view, to me, that feels like, that sounds like a slight de-escalation. You can see the live map there, Strait of Hormuz right at the top of your screen. A lot of ships at anchor on the right, kind of waiting to get in. A lot of ships at anchor on the left, waiting to get out. Nobody's kind of in the middle. But we'll see if those words, must be very careful, make it a little more amenable for some ships. Now, guys, we have had, I want to be clear, this whole, the Strait of Hormuz is closed. I don't like that word. Great job, guys. It's not, nothing's closed. There's no gate on this. You can make it risky. Plenty of Iranian and Chinese flagged or cargoed vessels are getting through because they're not going to blow up basically their own ships of their own oil. But I do wonder, and let's see what happens with the price of oil. And then the point I was going to make, guys, is this. And if you look out, we always show the front month contract, the April contract. That's the one that's up on the screen. But if you look out, there's other contracts, May, June, July. Look at that. I say it, and it happens. And you could see the price. And if you're on the radio, 96.47 for the front month for April. And you got 92.5, 86, and then basically just under 82. That's indicating, A, the market expects, it may be wrong, but it expects things to calm down. But also, I think it goes, Joe, to the extreme options positioning that we had in the market. You'd mentioned at the top of the show how, there's 3 million or whatever contracts. A lot of those were net short, which means when we got the escalation last night, everybody had to cover. They got their faces ripped off. And that's why we saw the price of oil have the biggest intraday spike percentage-wise in the history of oil, 35% gain. And it's also why oil's come down, because you've got those people they've covered. And now the market, I think, the positioning is going back to normal. But I'm watching these headlines coming straight off the Iranian Foreign Ministry. Feels like a de-escalation.
All right, our Brian Sullivan at CNBC headquarters. To your point, Brian, we're looking at those forward contracts. Certainly, it seems like the market is pricing a de-escalation. We'll have to wait and see. Brian Sullivan, thank you again. Joe, he called the shot. Former oil trader, you and I were talking about this before the show, the fact that you made, your bones in the oil market. What is your view of some of the things that Brian's talking about, the short covering, and just also this sense that the market seems to see some type of de-escalation coming up?
Well, I guess I didn't make enough bones because I'm sitting here with all of you, but I tried my best to do it. And understanding the market, when you look out on the curve, what you see right now is significant backwardation. And this morning I was looking at the curve and observing where we are in terms of the price gains months to date. So spot, you're up about 50%. You move out into the June and July contracts, you're up about 30 to 35%. Where I think the expectation that ultimately this conflict resolves itself is when you move into the fall. Those contracts month to date, they're only up mid-teens at best. So it looks like the market is expecting that you could have simmering tensions even as we move through the summer. They tend to alleviate those tensions as you move into the fall. To Brian's opening remarks surrounding the comments from Iran, look, protecting oil assets, I believe, is in everyone's best interest, including Iran. It would be sabotage for them to do something where the response would be to destroy or to impair their oil infrastructure. That's their economic lifeline. So whether it's the U.S., whether it's China, whether it's India, whether it's assets in the Middle East and the interests of everyone, I think the expectation is that you're going to protect these oil assets. And I do think right now, as I said at the top of the show, I do think you have to build in some excessive speculation into the market right now as far as what's unfolding. Again, it has that feel to me as precious metals did 1 month ago.
The only one that wants a straight close is Russia. Let's be clear about that, right? Because they want Russian oil to go out more in the market. China, obviously, I would say obviously, I don't know this for sure, but China has to be in Iran's ear. They've been a big benefactor of Iran, and they're not getting their oil, and that's where they get most of it from. So they want to flow through the strait. So they say be careful. I think it's a real leap of faith to try and parse what the Iranians mean by what they say or take it on face value. That's a big mistake, as we've seen
in a developing situation, especially.
Right, in a developing situation. So, so I think the trade down in the price is from speculation and nerves that drove it over 100.